Fighting with the mute there. Sorry about that, folks. Welcome, as always, to our Unusual Whales FOMC panel of experts. It kind of seems like everything in the FOMC landscape of the last 5 or 6 months have been more eventful, one after the other, than the year prior. And today's kind of no exception to that pattern. So I'm really excited to get some of our panelists' takes today. Now, those of you who have attended these spaces before know I like to keep them wide open for discussion, so feel free to chime in if you have anything to add to another panelist's point. Just give it a little breath of fresh air in between them finishing and you starting, just to help keep any feedback out of the background for our listeners. Now, I'm going to jump right into things here with some panelist introductions, starting off with Joseph Wang. As you know, our go-to Fed guy, headed the trading at the Fed's open markets desk, has a great introductory book I like to plug every single time on central banking called Central Banking 101, and he's the CIO at Monetary Macro. Welcome back, Joseph.
Hey, Nicholas. Hey, Unusual Wells and fellow panelists. Great to be back here. I always look forward to these panels.
As do I. I think they're pretty much favorite part of the job. I learn way more than ever every time we come on here. Up next, we've got the last bear standing, rocking an all-new profile picture design. Another friend of the spaces. Last Bear is an expert on markets where he writes about monetary policy in his weekly Substack that you should be subscribed to. A lot of really good information coming out of there, and macro reads by Last Bear. Welcome back.
Thanks, and I appreciate the plug on the logo. We did a little facelift recently, so I appreciate that. But looking forward to the discussion, and I'm sure it'll be a fun one.
It looks fresh as hell, man. It looks cool. Next, we've got Bob Elliott back, the CIO at Unlimited Funds, the former IC at Bridgewater, and also the PM of ticker HFND. He brings vast knowledge and some breath of fresh air, non-reactionary takes. It seems like it's been forever, even though we had him recently. Bob, I always love having you here. Thanks for coming again.
Hey, thanks so much for having me. I feel behind with Last Bear and his nice new logo, and I'm using the same picture from 3 years ago. So gotta get that updated, along with a bunch of new things, including a new fund we launched, HFGM, which is also in something that we're managing that's brand new as well. So look forward to being here. Always great to be on these spaces.
Hey, man, for all the listeners know, that's a brand new picture as of this morning, and you're aging more gracefully than anyone's ever seen, Bob. I think you're beautiful. We will as well, I believe, have one other panelist later on as we kind of get into things. I believe Jem Carson will be on the docket, but we'll keep things pending there. I want to jump right in because we do have a lot to cover before we get to Jerome Powell's presser, and I want to make sure we tickle at least 3/4 of these topics if we can. So to start us off here, I want to get a little framework of some of these topics, starting first with kind of a quick overview question, broadly speaking, starting with GDP here, which unexpectedly shrank by 0.3% in Q1 of 2025, which did catch quite a few analysts a little off guard, but was perhaps expected somewhat by others. Some chalk that up to quirks in trade data and inventory shifts, but many argue that this is too easy, too simple of an explanation, that there are signs of a deeper situation going on, from tariffs to international trusts crumbling in the United States. Joseph, from your point of view, if you don't mind starting us off, what are some of the main factors behind the quarter-over-quarter shrinking in GDP, and how can we expect to see things shift on the horizon?
Well, first off, that was a great summary. Like you noted, we did have a negative GDP print for the quarter, but then I think it's not something we really need to panic just yet. Like you mentioned, a lot of that seems to be driven by a surge in imports. The way GDP is calculated, when you have a surge in imports, that subtracts from growth because that's money being spent. That's not being spent within the country. It's being spent on businesses outside. And so the way that this is calculated, it's basically based on expenditures. However, when you look at, let's say, what some people think of as core GDP, that is final sales to the private sector, you'll notice that it was growing at about 3% annual rate. So that shows that at least before Liberation Day, we did have a solid economy before Liberation Day. Now, between then and now, a lot of things have happened. I think it definitely makes sense for there to be more economic weakness, not necessarily because of, what's all this stuff happening with trade, but just because there's no clarity as to what the tariffs would be and how progress on the fiscal package would be. Everyone is probably just standing by and waiting, and so that process is probably going to suggest at least some weakening in economic activity. And to be clear, we see some of that in the data as well.
Thank you, Joseph. Sorry for the pause there. I just spilled half a cup of coffee in my lap, but I do want to keep plugging along here. So kind of tying into what Joseph was saying, at the same time as this, we are seeing a noticeable hit taken by real consumer spending, and overall consumer confidence has also seemingly been slipping month over month. So would you say that based on this alone, are households more spooked by inflation sticking around, which we'll get to a little later as well, tariffs, or there are just too myriad factors making it too hard to pinpoint a direct cause? Last Bear, what are your thoughts on this one?
Well, I think there's definitely a headline shock sort of effect happening, which obviously shows up in all of the soft data, the sort of sentiment surveys, even business leader surveys, that sort of thing, which have been by far the worst looking data points that we've seen, but obviously taken with a grain of salt, given that they are sort of subject to a human reaction function. And so I think that there is an element of uncertainty for sure, both across businesses and consumers as to what's going to happen with the tariffs, what was happening with the market this past month. And it's possible that you also see some front running of tariffs. I think that there is evidence of that in certain areas, like auto sales were very strong in the first quarter, and seem to have fallen off a little bit after that. Maybe you have some pull forward in other categories. I think it's really hard to sort of differentiate between what's normal consumption and what might be sort of a reaction to what's happening going on more broadly. But I do think that that there is uncertainty that's going to continue, especially to the extent that some of these trade impacts start to really show up more tangibly. I think we've been in a period where it's been mostly headlines, and we haven't really seen a lot of tangible effects. So, for example, the 145 tariffs on China, those goods are just starting to arrive without under that tariff rate right now, and tariffs get paid as they, as products are taken off the port here stateside. So we're really only starting to see the early effects of these, the effect on imports, the effect on exports. There's been a huge drop off in, agricultural exports to China, as an example. And I think that as that moves forward, it'll translate from more of a soft data type survey reaction, maybe a little bit of return to the mean in terms of people's expectations, which really were quite extreme. I think coming out of some of the big announcements that we had from the White House over the past couple of months, maybe a little bit of reversion on sort of the soft data, but showing up a little bit more in the hard data. So that's what I'm looking forward going forward.
Thank you, Last Bear. Now, next, I'm going to pick on our man, the urban cowboy himself, Michael Cow, the Chief Investment Officer and Portfolio Manager of Cow Family Office, and an expert in commodities, convertible and capital structure arbitrage, and dynamic hedging. Always love having you here, Michael, and I'm going to pick that beautiful brain of yours now with kind of a tie-on to what Bob and Joseph were saying. I just wanted to bring up the University of Michigan here, whose sentiment reading dropped to 50.8 in April, which, if I'm not mistaken, is the lowest we've seen since early on in the COVID pandemic. Now, kind of a two-parter here. How much weight should we actually give to that sentiment in forecasting where the economy's headed? And do you kind of agree with what some of the panelists have said so far, that some of these reactions might be a little bit news headline driven?
Hey, thanks for having me again. It's great to be back on this panel. So I'm glad you brought up sentiment, because one of the things that I wanted to mention is that I see right now the macro environment, I think, is clouded by two primary biases. One is political bias, and the other one is what I'll just call home sector bias. Now, with respect to political bias, a couple of weeks ago, I posted a chart that I borrowed from my macro analyst friend Lakshmi that showed the University of Michigan Sentiment Index by political affiliation, as well as the University of Michigan inflation expectations by political affiliation. And I found this absolutely fascinating because if you're a Democrat, you had a very, very negative view on sentiment on the economy, and a very high view of forward inflation expectations. And then if you're a Republican, the expectations were exactly the opposite. Now, I just find that really, really interesting. And I really think that when you try to cut through this political bias, the truth is going to settle in somewhere right dead smack in the middle, somewhere right in between. So I take some of those sentiment indices with a huge grain of salt, and I think you have to look through that. And with respect to what Last Bear was saying in terms of the hard data, so I've been really thinking about the tariff impact on recession, because that's obviously the big front and center boogeyman. And I feel like I'm in the minority these days, where I actually think that we'll probably avoid recession, at least from tariffs, because about 3/4 of U.S. GDP is services, and I estimate maybe only about 10 to 15% of US GDP to be directly exposed to tariffs, manufacturing, retail, a little bit of ag and mining. Um, so this is where I talk about this home sector bias, because you hear these podcasts and interviews with people. For instance, like the CEO of Flexport recently said that an asteroid is going to hit the U.S. economy with all mass bankruptcies, blah blah blah. But again, that part of the economy, what we're dealing with here is it's not like a heart attack that COVID presented. This is more like a hiccup, and the hiccup can go away with some steady breathing. um, and doesn't require a major defibrillation. Now, where I am more legitimately concerned about the economy are sort of factors that were in existence before the tariffs, meaning we've definitely had a reduced fiscal impulse with the incoming Trump administration, right? And even though I know everybody's disappointed at the Doge numbers, but the point here is that the Doge numbers actually, the fact that Doge actually cut is saying something. Um, and then the other thing is, so there's a reduced fiscal impulse, and then there is also the consumer exhaustion from all of the COVID stimulus, right? And also, of course, the U.S. economy sports the highest real rates of the G10. So those preordained, or sort of pre-existing, I meant to say, pre-existing factors are the bigger concerns. I don't think tariffs alone are going to put us into recession.
Thank you, Michael. So I actually want to kick one of these around the panel here. Now, politics set aside, looking a little bit more at some information that we do have that are, by most economists' points of view, directly tied to tariffs and possibly the trade war sparking, and that being the threat to supply chains amidst this tariff uncertainty. Now, indeed, we have already seen some signs of this, especially with China. Some of those projections, as high as 35% of shipments to the West Coast, for example, to drop off, and container bookings from China to the US falling 45% year over year. A lot of that happening, not necessarily since Liberation Day specifically, but since the tariff announcements and the pushback that came from it began. What sort of effects do we expect to see from this, especially if shipments fall even further? And is this a good indication of, like I kind of tickled at the beginning of this little spiel, is this an indication of direct effect from tariffs specifically? I do want the whole panel on this one, but let's start with Bob here.
Yeah, I think one of the biggest challenges that we're looking at right now is essentially we've set up an embargo on Chinese goods. And in the short term, you know, basically everyone has at least some stock on the shelves that they can absorb it. And so if it were to reverse, you know, in the next month or two, probably there wouldn't be significant macroeconomic consequences. I think the real question is if some form of the embargo remains in place, how magnified is that impact? Of course, imports from China are a few percent of our GDP. In and of itself, probably not that big a deal if you were just talking about, the imports. The real question is where do those imports fit in to all of the goods related and to some extent services related activities that happen in the economy? And the reality is what something like 1/3 of the economy is some sort of direct or indirect goods related consumption. And pretty much there isn't a place in the economy that isn't influenced or isn't supplied by Chinese goods in one form or another. And so I think of my kids' soap, which is made in America, but is the bottle is produced in China. Is such a perfect example of the type of stresses that lots of companies are facing, even things that are quote unquote made domestically. And so we have the thing I would emphasize is we have no idea. In the same way, when we were standing in March 1st of 2020, we had no idea of all of the second and third order consequences of, turning off the economy the way that we did. We don't have a full appreciation, and nobody does, of all the different ways in which an embargo will disrupt activity throughout the economy and the services and goods sector. And so the main thing is like, the direction, I'd say at the same time, the direction is pretty clear, which is if this sticks around, it's going to be a negative. And if it's a negative compared to equity markets in particular that are pricing in very, very optimistic conditions, any persistence of the tariff environment or the Chinese embargo is set up to disappoint very, very elevated equity expectations. And so that's, a lot of uncertainty in terms of the macroeconomic consequences, but actually when it comes to the markets, a lot less uncertainty because the markets have basically fully priced in a full-scale rollback of the tariffs. And, the range of outcomes are certainly include that, but they also include a reasonable possibility that they stick around for a while.
So I want to kick this one around the panel, like I mentioned, and to your point there, Bob, about not quite knowing exactly what'll happen amidst an embargo. I think the only example I have that comes to mind is the Embargo Act of 1807, and I would argue the world's a little more intertwined than it was back then. Michael, I see your hand, and then we can keep this thing rolling around the panel.
Perfect. I wanted to chime in on some of Bob's thoughts here. So I totally agree that I think the market has priced in a lack of persistence of any of these tariffs, and I think that's where the market is going to get disappointed. For the last month, I've been thinking about this tariff strategy through a geopolitical and economic statecraft lens, and I think that I broadly classify tariffs into two categories, what I call long-term incentive modifiers and short-term negotiation tools. And this is what I would be advising the administration if I were in that seat, saying that there are critical path industries like chips, ships, drugs, critical minerals, energy that need to have persistent tariffs, and perhaps they need to even be set at embargo rates like 40, 50% to incentivize long-term behavioral modification. And maybe there's a ratcheting mechanism. And then there are the reciprocal and the punitive escalatory tariffs of like the 145% tariffs on stuff like what I call t-shirts and tchotchkes. And I think that those ultimately will get negotiated down to possibly zero. And so this is my wish list for what the administration will do from a long-term geopolitical perspective. And for the first time yesterday, Scott Bessent indicated that that's exactly where they're thinking. He made some comments yesterday on the eve of the upcoming talks with China, saying that we don't need to necessarily decouple in areas like textiles and such, but there are other critical industries where we do need to decouple, and that's exactly what I've been anticipating over the last several weeks. So I think that that's something to watch out for, and there definitely will be some impacts on the market and the economy in those sectors.
Thank you, Michael. So just for the panel here, and we're joined by Kai Volatility, leading volatility expert Jem Carson as well. And I'm going to throw him straight to the wolves here if he's caught up enough to what Michael said here and to some of Bob's points as well. Is this considered a negotiating tactic, or are we seeing a real shift toward decoupling the U.S. from the world abroad? The IMF, for example, has said that the tariff situation threatens the very stability of the global markets. And I'm wondering, for your point of view, Jem, just how accurate is that?
Look, people forget that Donald Trump has been talking about this since 1980. This is not, everybody paints this as like this is just a political thing that he's doing. Yes, it is, by the way, the number one thing that has drawn people to him and why he has become a vehicle for the populism that has come to us at this point of the cycle. But the tariff thing is not something he just came up with. And by the way, we have shipped our jobs abroad. That's what monetary policy is, sending all the money to the top, to the corporations. Corporations are profit seeking. They look, water flows to the lowest point and finds the cheapest labor. That's how the system works. But no matter what you think about Donald Trump, one thing he has been consistent about for 45 years is the need to make things more in America and to not ship our stuff abroad. And so, no, I don't think this is a negotiating tactic. Yes, the art of the deal is part of who he is. And yes, there are always, a big chunk of what he does is not necessarily exactly what's going to happen. But I think if you're confusing that the whole tariff thing is just a ploy to extract concessions and then move on, I think you're playing the wrong hand. Importantly, outside of just who he is and what he believes, and we can talk about whether he's principled or not, but you have to understand we are in a very populist time. We have talked about that on here for 3 years. If people don't see it by now who have been listening to us here on the spaces, you're missing the big picture. And you saw this, by the way. The Trump administration came in with two sides. It came in with Elon Musk, I would say Bessent tangentially connected to Elon Musk, and basically corporate America, basically arguing supply side economics is the way out of this mess, which is, by the way, if there weren't human beings in the system, that's right. There weren't voters, that's right. And then you had the core Trump, the Navarros, the Lutnick, that side, and the Bannons and everybody else, everybody from Trump 1.0. Who brought him politically, who made him politically popular, who got him to where he is, right? Arguing for tariffs and protectionism and populism. Those two concepts were always in complete contradiction to each other and were unsustainable together. And it took about, by the way, when everybody was like, well, no, they're going to cut, spending at the bottom, and they're going to, get a Fed response, and they're going to do a big tax cuts for corporations, and we're all going to go back to to 2010 to 2020, 2021. And my answer was, okay, good luck. Like, that's not going to happen because politically it is unpalatable. And what happened in the first 100 days? Exactly that. They tried to signal those things. They tried to slow and pull through both Doge and through all of the cuts to SNAP payments and Medicare and all the proposed budget things. They tried to cut spending and are trying to do supply side economics. You know how that ended up? That ended up with bonfires at at Musk's dealership, Tesla dealerships, and Elon and Bessent yelling in the hallways of the White House. It's a political nightmare, and his 100-day kind of approval rating is the worst of any presidents in World War II. And that's why you're getting the pivot, and that's why you're getting a move back to his base, which is populist, and his core principles. So my view is no, this is not going away. They will try and make quote unquote progress. They will try and support markets and do what they can, but they are not getting the support from the Fed and monetary policy. They're backing away from spending. By the way, is above what it has been the last 4 years for the first 100 days. It's higher than it's been. Period. So you can listen to what they're saying, but I think to misjudge this as just a negotiation would be incorrect.
Fair enough, Jem. A lot to unpack there as well. Joseph, do you have any responses or anything to add to some of Jem's points there?
No, I agree with Jem. If you look at, if you can go Google a front page ad Trump wrote in the New York Times in 1987, and he's talking about, these countries are ripping us off. They don't pay their fair share. We protect them. Basically, exactly the same things he's saying today. Like he hasn't changed. But I think there is a legitimate problem here too, because if you zoom out and you look at the goods trade deficit of the United States, it's growing and growing, and right now it's over $1 trillion. That means the United States is buying more than it sells to other countries, and that difference is $1 trillion. So it's a very large goods trade deficit. Zooming out, looking across the world, China has a goods trade surplus with the rest of the world, not bilateral with the US, but with the rest of the world, of over $1 trillion. So basically, you have a country, the United States, is just consuming too much stuff, particularly from abroad, and you have another country that's just producing too much stuff and selling it abroad. So this is a very legitimate global imbalance. And I think many people would like to solve that. The way that President Trump is approaching this is, as Bob described it, as a trade embargo with China. And it is kind of a cold turkey thing, so it is pretty extreme. But I think on top of that, they're also trying to add tax incentives to encourage domestic production, deregulation, and things like that, and getting oil prices down. So it's part of an effort to just reshore industry. Part of it is for national security reasons. Like Michael mentioned, we need to be able to produce our own steel, aluminum, and military sensitive technologies, pharmaceuticals, and so forth. So I think at the end of the day, what we're going to see is just tariffs, about 10% tariffs on everyone in the world, and probably 50 to 60% tariffs on China. That's what President Trump mentioned on the campaign trail a year ago, and that's, I think, what we're gradually moving towards. So this is definitely something that's structural. Don't seem like the market is understanding this, but then the market didn't really understand Liberation Day either. I think many of the people on this panel were telling everyone that President Trump's the real deal. He's going to do something, and I think many of us were proven correct on that day. So yeah, it's kind of a strange thing to see in the market. I noticed that yesterday when President Trump was giving a news conference, he was teasing everyone that there's going to be this huge announcement. Maybe you've never seen anything like this before. It's going to be the best in the world, and the market popped on that. But the last time he said something like that was Liberation Day. So I don't know if that's the right approach for that. So this is something that's a big change in the world. And one other thing that I'd add is that if you look at the staff in the Trump administration, you have Peter Navarro, who of course is a famous China hawk, wrote a book titled Death by China. You have U.S. Trade Representative Jamie Greer. He talks about decoupling with China. So this is a structural regime change in how the world works. And so I think the future is definitely not going to be like the past. Hopefully everyone is aware of that.
Thank you, Joseph. And kind of as just like a little tie-in on this, just more specifically between the U.S. and Canada, real quick here. Just this week there was a pretty tense exchange with Prime Minister Mark Carney and Trump, floating that idea of renegotiating the USMCA terms. And then, of course, there was the typical joke about Canada becoming a state, which was quickly rebuffed. But I'm wondering, with these types of potential negotiations happening on what was a long-standing strong trade agreement between the U.S., Canada, Mexico that changed slightly during Trump's last administration, now looking at renegotiating again, how do situations like this affect investor confidence in NAFTA successor agreements? Les Bear, what are your thoughts?
Yeah, so maybe just quickly before that, I just wanted to add a couple points to the prior discussion, just around the shipping element. So I think actually I've been spending a lot of time trying to separate hyperbole from data in terms of what's actually happening with import volumes, what's happening with data coming from China. I think one guy who I'd encourage people to follow, I believe his name is Sal. He has a YouTube channel called What's Going On with Shipping. He has really good, solid data-based approach to this, and he puts out regular updates. And I think he's been a great resource, so I wanted to plug him. But if you look at the actual container ship volumes out of China, obviously they sort of fell off a cliff from March. Or from early April, but that was a very elevated level. And if you actually, Bloomberg has a couple tickers that sort of track this. And if you look back, it's actually at the same level that it was in sort of early 2023, which granted was the low point in sort of the goods cycle. And so it's, a big step down from 2024 levels, but it's not going to zero. And it's, obviously there's exemptions to tariffs. There's sort of washing of tariffs by, trying to say that things are from different countries and trying to get around those sort of regulations. There are going to be shipments that have to come regardless because they're essential components. There are, some amount of containers that might just come and sit and dwell at the port of Los Angeles, and if tariffs aren't paid, then they'll sit there and clog up the port. So I think that the situation with shipping is more complicated than just it went from 100 to 0 and it's at 0. It's not the case right now, but that's not to say that it isn't a big issue that's going to persist going forward. And I think as the time is really the compounding factor here. So the longer that this lasts, the longer you have disruptions to the supply chain dynamics, physical supply chain dynamics, like where are the containers? As we saw the stuff back in COVID. We might get another lesson in those in the coming months, depending on what happens. And I do think, just then moving to your next question around North America, it is interesting that I think that, obviously some of the original tariff announcements were focused on our immediate neighbors, Canada and Mexico. And then since then, it seems like we've shifted that, or the White House has shifted that perspective towards viewing North America maybe as a more of a free trade bloc relatively, and focusing more on external trade from Asia and Europe. And if you think about, just adding in the geopolitical layer, it's interesting that Trump is talking about Canada potentially joining what emerging the artificial lines with Canada, Greenland, talking about potentially taking Greenland by force, something that you would never expect to hear a president say in any sort of open way, and then all the way down to the Panama Canal and the Gulf of America. It seems that Trump very much has a view of the North American continent, I think, is sort of where his eyes are set on, if you want to put like a triangle around it, from Alaska to Greenland to the Panama Canal. And obviously, there's a lot of opinions on that and geopolitical considerations with that. But I think from a strategic lens, at least the current White House is sort of viewing this as sort of an economic bloc. So it'll be interesting to see how companies navigate sort of the Canada-Mexico dynamic, potentially seeking to avoid harsher tariffs from overseas by sort of having more activity flow through those countries. But I think if you think about it from a broader geopolitical lens, there is potentially an alignment around North America versus the rest of the world.
Thank you. Last bear, Michael, comments before I pick on Bob and then spin us to monetary policy.
Yeah, I just wanted to spend a couple minutes on geopolitics and economic statecraft as well. So I think I totally agree with Last Bear on the North America block. About a month ago, I had a podcast with Michael Every, who's the global strategist at Rabobank, and we talked about how the end economic statecraft goal was to create a sort of closed loop North America bloc. With despite all the hostile rhetoric between Trump and then Prime Minister Trudeau, I think ultimately realpolitik is going to win the day here, and I think the North America bloc is something that will happen eventually. The other thing I'll add is that I've been warning a lot of my retailer CEO friends that where everybody's scrambling to move their supply chains out of China. But I think it makes a big difference as to where people move, because I think Trump 2.0 is very serious about economic isolation of China and closing the loopholes, not just transshipment loopholes, but also like trans manufacturing loopholes. So, countries, for instance, like Cambodia, Laos, that tend to be historically China aligned, I call it the, out of the frying pan and into the fire risk. So, if you're a retailer moving into some of these other countries, you have to be very, very careful, because you may find those loopholes shut. So, yeah.
Thank you, Michael. So the last thing that I want to touch on this, and I do want to get to the Fed monetary policy rather and strategy. It's been mentioned before on the panel today. Just this week, Trump said that the U.S. quote doesn't have to sign any deals with China. And prior to today, when Bissent said that, I think Sunday is going to be when the Chinese American negotiations begin. Prior to then, there was, no confirmation from the White House of any negotiations. But that notwithstanding, Bob, you recently posted that China's latest policy shift keeps pumping the supply of credit when demand remains the problem. And you went on to say better than nothing to cushion trade war drag, but far from the big bang that's needed. Can you kind of talk us through this one, Bob? What is that big bang that is needed?
Well, I think the Chinese situation in many ways has not really changed for, several years now. Really not since the post-COVID situation where, you have a private sector, and particularly a housing market that's taken on far too much debt, drove both activity and prices to unsustainable levels, and where, there are significant overcapacity and losses in the system that have yet to be recognized. And the question then, faced with essentially a structural over indebtedness and credit problem is how do you deal with that problem? And the Chinese have sort of consistently struggled, I'd say, to apply a set of policies that would really resolve the issue. If you remember, essentially the US faced the same thing in 2008. What did we do? We recapitalized the banks, double what they needed, and stimulated, private sector consumption and printed a shit ton of money. And you look at what China's doing, and, most of what they're doing is on the supply side. So even today, cutting repo rates by 10 basis points or something, cutting the reserve requirement by 50 basis points. If there were issues where the supply of credit was a problem, then those things could possibly matter. They talk about freeing up 1 trillion yuan of capacity, but the supply of credit in China is not a problem. If you want to borrow, you can borrow all you want. Particularly, you can borrow all you want if you're on a prioritized industry. The problem right now is that no one wants to borrow, no one wants to invest, and no one wants to buy assets because they're all depreciating in value. And so faced with that circumstance, what they need to do to sort of tactically to manage the debt situation and then structurally to manage the debt situation is that they have to figure out a way to stimulate domestic consumption rather than, lean even further into more manufacturing and, more bigger surpluses. And so, the interesting thing in the context of all of these international strategic, geopolitical issues is honestly the best thing from a negotiation standpoint that the U.S. should do is they should sit down and say, hey, why don't you engage in a 5% of GDP set of stimulus checks to consumers? That would radically change the picture. Why don't you clean up your banks and recapitalize them? Why don't you, restructure the debts of all the over-indebted private sector entities? Those would be the things that could unleash a surge in Chinese demand that would both address the structural imbalances, spending versus savings imbalances, or spending versus manufacturing imbalances, and also would deal with the longer term debt problem. But for some reason, and I say that with an open mind, there is certainly some reason why the Chinese policymakers are choosing not to do that. I think you could probably speculate on why that might be, but they aren't, and instead, what they're doing is sort of doubling down on all these supply side dynamics, which you can pump the hell out of the supply side, and on the margin it'll make things better than they would be otherwise, and on the margin it'll help cushion the trade problems. But it's not going to deal with the international problem of the structural rebalancing that needs to happen to satisfy their trade partners, and it certainly is not going to deal with the malaise, let's say, that the Chinese have faced over the last 5 years.
Thank you, Bob. Michael, did you have something to add to that before I move us along?
Yeah, I shared something in the nest just now that directly addresses this issue. I think the fundamental problem with China is that they have a top-down investment-led GDP targeting economic model that for 40 years has revolved around the real estate industry. And as we all know, that jig is up. They've got 100 million unoccupied housing units, another 100 million or so in various states of incompletion. So call it 200 million unoccupied housing units. I mean, China could solve the world's homeless problem if only they had immigration, right? But anyway, that jig is up, and so the CCP Eye of Sauron has changed its focus to industrial capacity, especially as of 10 years ago, and in critical path industries. The problem here is what I call this runaway assembly line syndrome, where they need to churn out goods regardless of regular economic supply demand signals. This is not the type of globalization that's based on comparative advantage. And to Bob's point about them not transitioning to a consumer economy, I highlight in the nest this thread that Michael Pettis wrote this morning, which I totally agree with, because I call it, this is their issue is that if they actually transition to a consumer economy, it would cannibalize their existing top-down economic model, and it's kind of like a sovereign level innovator's dilemma problem. So I think they're fundamentally stuck, and that explains why all these years of like Chinese bazooka stimmies have been nothing more than what I call lipstick on a pig stimulus measures to maybe, gin up stocks, but they're not addressing the fundamental problem that China has.
Thank you for the additional context, Michael. Now here we've got about 17 minutes before we get some data, so I really want us to take this time to talk about monetary policy, the Fed strategy, and a little bit more on the subject of inflation itself. Now, starting off with this, the Fed last held rates steady despite slightly weaker GDP and the following the falling confidence we discussed earlier at the last FOMC. And it's pretty highly anticipated the same thing will happen again today, which some read as a sign that the Fed thinks things are under control. Mohamed El-Arian, on the other hand, recently said the Fed seems to be boxed in, risking either looking too slow or too reactive. So I'm going to start with Joseph on this one and then kick it to Jem. And then panel, please feel free to chime in after that. Do you agree with El-Arian that the Fed is out of room to maneuver, or are things indeed under control currently? Do we anticipate some semi-linear path forward from here?
So I don't actually think it's that hard for policy at the moment. But anyway, as I understand today, JPow will just show up and flip a coin and then he'll decide what to do. But in any case, so right now on the FOMC, you have two camps, right? You have one camp, I think that's probably more in line with how Mohammed thinks, and that is that you have inflation expectations. So the economy is weakening. We have slower GDP growth. The labor market is softening. But at the same time, you have inflation expectations rising for certain groups of people, as you noted earlier, Nick. So this is a problem because the central bank is worried that, let's say that they try to address the economic weakness by cutting rates, then potentially they can risk inflation getting out of hand because inflation expectations are higher. So Chair Powell has emphasized that he's going to try to keep inflation expectations anchored. And so he's basically committing today to being late by just sitting down and watching the data and not doing anything until he actually sees breakdowns in the data. And that's not in line with how he usually acts. Last year, for example, he did act preemptively and cut 50 basis points. So instead of being ahead, he's committing to being behind, trying to address this fear of inflation being rekindled due to high expectations. But there are also others on the FOMC, led by Governor Waller, who thinks that we should cut if we see economic weakness, particularly when it comes to the labor market, because if we have tariffs, yes, prices could go up, but it's not a change in the rate of change. It's just a change in the price level. So we could have, let's say, a one-time increase in the level of prices, say a few percent, but then that doesn't mean that next year we'd also see a similarly large change in prices. So it's a jump in the level rather than the rate of change. And in that case, you would just cut when you see economic weakness. So I actually think that Governor Waller is more correct when it comes to this, because the inflationary impacts on tariffs, that seems to be, as Michael noted before, there's a lot of politicization in this. So going forward, if, let's say, tariffs raise prices, what happened the first time around was that the businesses absorb that with high margins, and business profit margins are historically on the higher side now. So that continues to be possible. But even if it were to be passed down, at the end of the day, if you look at how our inflation indexes are constructed, goods is not a very big part of it. It's mostly services. And as the economy weakens, as unemployment rises, you already see that the wage inflation is declining. And so that's going to moderate against the increase in goods. So I personally am not concerned about inflation this year. And so if you have economic weakness, even though I understand that there are people who are panicking about higher inflation, these sentiment things can change very quickly. We see oil coming down, for example, and as oil comes down, uh, crack spreads staying constant, you're going to see gasoline prices come down as well. So that should address a lot of the inflation expectation concerns. So I think it's kind of, if I were the Fed, I would just cut when I see economic weakness, and it would be reasonable to me. We would not be unreasonable to do that really soon, since we do see weakness. But politics affects consumers. It also affects Fed members too, I imagine. So maybe they are legitimately or honestly concerned about expectations getting out of hand. Maybe they are afraid themselves.
Thank you, Joseph. Jem.
Yeah, I don't remember the last time I disagree with Joseph, but I'm actually going to disagree with him for the first time in forever. We usually agree about everything. Look, I think if you look at how this started, when the Trump administration came in, as I mentioned before, there was this debate as to whether they were going to run at least somewhat supply side policy to help counteract the protectionist policy they were talking about, and to try and bring the 10-year down and get inflation down, right? That was their focus. And by the way, correctly so, that needs to be the focus for all parties involved at this point. We can debate whether or not tariffs decrease economic activity in the U.S. That I'm not so convinced about. That is more of a take from the rich, give to the poor, take from corporations, give to individuals situation over the medium term. But what we can't, I don't think that there's much debate as to whether or not tariffs are inflationary, right? Like you can't take the cheapest producer of goods in the world and cut them off from one of the most expensive producers of goods in the world and expect there to be no inflation. I think what we've seen, what we've seen for 4 or 5 years, and we've all talked about here, is that stickiness to inflation that was driven by, demand side, a move to more protectionist populist policies, more fiscal spending, more protectionism, et cetera. And at every turn, we've had transitory 1.0, 2.0, 3.0, 4.0 at this point. At every turn, inflation has been higher than expected. And under this administration, the tariffs are a massive escalation of that populism. The question was, were they going to do some other supply side economics? Were they going to cut, SNAP payments, all these other things in the budget? Well, that was potentially going to happen as of a month and a half ago. Look at where the budget is now. We're eliminating taxes on tips now. I want to reiterate, eliminating all taxes on tips. I don't think enough people talk about that. That is fiscal spending on steroids. We are increasing the defense budget. We were talking about cutting it. We're increasing it by $150 billion this year. We are way above spending where it was before, and we were already running hot. So spending is up. We are cutting cheap supply of goods from abroad. Under what scenario is this not inflationary? I think to go back to the mental model, Joseph, that we are back in a recession is coming, so that 10-year will come down, and cyclically it's going to slow inflation. I think the focus on a recession here is can we go into recession? Yes. Will it likely be mild if we have it, unless the market absolutely collapses? Yes. And why will it be mild? Because we're taking from the top 10%, which has been 50% of retail spending, and forcing it down to the bottom. By the way, not a surprise that the employment numbers were hotter than expected. At every turn, they've been hotter. Protectionism and populism means that you actually don't get hurt on the jobs front as much as people think. Guess what? If we make America great again, we're going to bring jobs back. They may be low-paying jobs. They may benefit the bottom 20, 30, 40%. But employment is not the problem here. We're going to have more jobs than we need to fill because we're taking them from abroad. Right? It's the distribution of income. And that's the problem, and that's inflationary. And that's why we are where we are. So I completely disagree. Can a slowdown caused by uncertainty and maybe a wealth effect where the market comes down drive a recession like 69, 70? Yes, it can. But as a mild recession, the 10-year will not come down. Inflation will not come down. The curve will steepen. And if the Fed stimulates, which it eventually will, inflation will take off. That's my opinion.
Now, to that point a bit, inflation, I think, currently running at about 2.4% or just under, but some projections do have it pushing back above 3% by the end of the year. And so I wonder, Joseph, if you'd also like to respond here, and I do see Michael's hand, so we'll start with Michael. Is the Fed underestimating how sticky price pressures might get as we move into the summer and the fall?
So usually I agree with both Jen and Joseph, but this time I think I side with Joseph here. I'm of the opinion that, well, number one, with respect to tariffs, yes, you will have a price shock, but I think what people are also underestimating is the demand destruction that comes with the price shock. And especially when you look at edge cases like, the 145% tariffs, I think everybody agrees that those are embargo levels. Well, what happens if you take it to 500%? It doesn't matter, right? Because volume goes to zero. So ultimately, I think that there's a big demand destructive element. You might probably have a surge of inflation in the beginning. And it also depends on, if you go back to what I was saying about this nuanced view of long-term incentive modifiers versus the short-term negotiation tools, I think it'll be in specific sectors where you might see lasting inflationary effects, but not all sectors. That's my opinion. And then the other thing is, I think Bob touched upon oil, or Joseph touched upon oil. I think that's a critical input, because in 2021, it was basically high oil prices that led to the dollar wrecking ball in 2022. And I think that by getting oil down, and by the way, I don't think the oil bear is done. I think we're going to see oil in the 40s before all is said and done. It's hard for me to see a runaway inflation situation with $40 oil. And so when it comes down to Powell, I've been saying that, I've been a big critic of Powell for being pusillanimous Powell for his December 23 rhetorical pivot, and then his premature pivot in September, when he really had no reason to squander all those bullets so early. But now I kind of side with Joseph that, at least now there is a modicum of uncertainty with respect to unemployment and the economic outlook. And now it seems like he's squandered a lot of bullets when he should actually. So I say that, pusillanimous Powell has all of a sudden transitioned to parsimonious Powell, which is, it looks kind of political to me. That said, I'm a supporter of Fed independence, and I think Trump needs to just shut up about that. But I do think that there's much more of a case for easing now than when he actually started cutting.
Thank you, Michael. So we've touched a little bit on jobs. So I do want to take a little detour into the topic of jobs. The April jobs report showed 177,000 new positions, but those are mostly concentrated in healthcare. And in addition to that, somewhat in line with what Jem was saying, we might see that pop in employment. Unemployment itself as a whole is still stuck at 4.2%. Now, would this be considered kind of a solid jobs market, or are we seeing the beginning of softening just below the surface? I want to go last bear on this one and then kick her around.
Yeah, well, I would say on employment, what you've seen is we went from probably the tightest labor market, maybe ever in 2022, with the bounce back and shortage of workers, and that has continued to sort of come down and ease consistently for the past 3 years. And in one way, that kind of because it's consistently eased and it hasn't been a problem for markets or the economy overall, we've looked at that as broadly a normalization, and I think that there is normalization elements going on there. But at the same time, we haven't seen an inflection, a stabilization or inflection upwards. I would say maybe a little bit in the fall this past year, it seemed like there was some positive indications on job openings and hiring rates. But I think that's kind of come off again a little bit in the past couple months. The ADP numbers, which I think are a little bit better than the BLS numbers, have shown weakness in the past 3 months. So I think that we still are in sort of a structurally tight labor market, but it's one that's absolutely weaker than it was, a year ago or 2 years ago or 3 years ago. And to the extent that there are impacts on exports or imports or just broader business uncertainty, that could continue to deteriorate. So I kind of view at the same time on the inflation side, I know people have mixed impressions about trueflation numbers, but over a long time, they do, even if they don't match month to month, they sort of do follow the same trend as BLS reports. And those numbers continue to look really low. And I think part of that is the energy dynamic. There's also an element here with export volumes declining, which could actually decrease food prices or food staple prices in the U.S. domestically. And I do think that it might be appropriate. I don't think that anything's going to happen in the next 2 minutes, but maybe in coming months that we could see further cuts.
Michael, I see your hand. Did you have something to add there?
Nope, my hand wasn't up.
All right, Twitter's just giving me the bait, and I fell for it, hook, line, and sinker. So still on that same topic here, I know we got about 2 minutes, so once we get the data drop, we can obviously pause, take a look at the dot plots, talk about that before we come back to this. But still in line with that aspect of jobs, wage growth itself has basically flattened out recently, and we're still obviously seeing prices rise almost across the board, groceries, goods. Does that mean workers are about to feel another sort of squeeze with prices rising and wages maintaining a flat line? Bob, what are your thoughts?
Well, I think the point about whether, let's say, tariffs do persist for an extended period of time and the prices of the relevant goods rise, how much are we going to see a rise in inflation versus of overall inflation, let's say, versus demand destruction, which will result in weaker growth. And I think it really comes down to the wage environment, sort of market, and probably more so than any other indicator that what really matters is we're seeing a deceleration in wage growth, which means that there's less nominal spending power for households to continue to buy. And so that's a pretty different story when incomes were growing pretty rapidly on a nominal basis and were supplemented by government transfers during the first bout of inflation. We're basically on the other side of that equation with a deteriorating labor market today. And that really suggests that it's much more likely that the supply chain disruptions and the price rises of particular goods will lead to a broader demand destruction in real terms rather than a broad-based price rise. It might be measured that way, but the economic effect would be contractionary as a function of that, in the same way traditional supply side shock is often contractionary economically if it happens, in an acute way.
Thank you, Bob. Now, hot off the press here before we circle back, the Fed Reserve, kind of as expected here, has not cut rates and keeps holding that benchmark lending rate steady at a range of 4.25 to 4.5%. So I'm just going to give the panelists a little time here to look over the release and digest the data a little bit. So kind of while you're reading through, folks, feel free to jump in with any commentary.
I would just say that the commentary is very even-handed from the Fed. They talk about that the unemployment rate has stabilized, market conditions remain solid, inflation somewhat elevated. So again, they're not at least publicly expressing concern over weakness.
This is a statement that suggests that they should not do anything anytime soon, and they're creating room for that, particularly in stating that the risks of both higher unemployment and higher inflation, and so they're giving themselves cover to do nothing for some time, it seems.
Yeah, it seems like the highlight is increased uncertainty. So the Fed didn't know what to do last time, and even more today, don't know what to do.
Parsimonious Powell.
So just kind of on the surface here, do we see this as continuation of just testing the waters over time, being a little less reactive, or are we still seeing too much, for lack of a better word, too much of a conservative take on whether they cut or not?
I think that there's also an element of fighting the last battle here. Obviously, the Fed was arguably quite late to the last inflation battle and arguably turbocharged it in its early stages. And so I think that that's combined with the political element and trying to maintain neutrality is a element here. Whereas if we didn't just experience a really significant period of inflation, I think that there would be a whole lot more caution on the side of the Fed.
I think that's a good point. We did have large inflation recently, but then at the same time, last year we did see them cut preemptively when everything was fine, stocks were high, economy was growing strongly, cut 50 basis points preemptively, and then now just kind of totally changed that policy. I don't think that's a good look for the Fed.
On the contrary, could it be perceived as, hey, maybe we made the wrong move, we should be more cautious moving forward? Like, is it inherently a bad look, I guess I would say? Does it instill the lack of confidence in those paying attention to policy, or does it show the Fed's willingness to adjust based on new factors that come to light?
I think it shows that JPow is the master of skating to where the puck was 5 minutes ago, because he's also the same JPow that basically was buying 100 billion of MBS as NFTs were going to the moon. So
And housing scoring 20% year over year in price increases too. That was a really strange policy choice back then.
I think the challenge here is, let's say there was no tariff situation going on. And to be clear, the markets are pricing as if, in 60 days, it'll all be gone. The economy, absent the tariff risks and some of the negative, marginal negative growth efforts by the new administration is fine. Like, as Joseph said, kind of at the top of this, real final sales in the first quarter was 3%. It's been 3% for 2 years. 3% is pretty good. And so that really is a challenge to basically be like, well, we could either go down a path in the next 3 months of continued strength, for which there's no real reason to do anything with rates. And to be frank, there was no real reason to do anything with rates, in the fall either. But, that's water under the bridge, I guess. Or we're going to have an incredibly detrimental economic supply shock that, could drive the economy into recession and drive inflation higher. It's a pretty tough call to make, let's say, in terms of which one you do. And so I think the only thing that you can do in that situation, the only reasonable path is to do nothing.
So kind of spinning us here, there was a brief mention here on that topic of housing. So I want to touch on that and see if we're kind of looking at, kind of a turning point in the housing market, or if we're looking at more of a temporary reset in the housing market. So inventory's up 30% year over year, I think it was, while pending sales dropped 3.2% in April alone. So is this early stages of a real reset, or is this just, buyers hitting pause because of those high interest rates? Let's hit last bear on this, and then please, anybody feel free to chime in.
So I think for real estate, you can't really look at the whole country as a total. You have to look at regional dynamics, because they are very, very, very different right now. So in places like Florida and Texas, and sort of the area that probably saw the highest level of appreciation and net migration in the early days of COVID. Also places where there's ample land to develop and build new housing. Those are the markets that you see sort of really significant increases in inventory even over last year, and could see a little bit more of a correction. But if you look at places like in the Northeast, inventory is a fraction of what it was before COVID. But it is interesting also, at one point, as it relates to inflation, there's the new tenant rent index, which just a point on the data here. The most recent data points always seem to look way too low and get revised higher. So I'm removing the most recent data point. But even still, if you were to look at the trend over the past year, those rental rates are now going below where they were in the prior decade. So continuing to go down as you see rental vacancies increase overall on a national level. You had a ton of new supply, especially in multifamily, come in the past couple of years. You have migration slowing down significantly under Trump. That reduces demand for housing. So I do think that there are signs of slowdown for sure in the housing market. And the housing market is just, it's not like the stock market where you have 20% down in a month and a V-shaped recovery. If you think back to like 2008, which obviously is an extreme example, but housing prices peaked in 2006-07 and they bottomed in 2012. You're talking about years for this market to reset. And I think with that, for much of the country, we've been in a period of, freeze effectively because people can't afford new mortgages. Nobody wants to move. At the same time, there's a new premium on housing based on remote work and all these kind of things. And so it's been in this sort of, Titanic freeze zone that maybe will start to loosen up in certain areas. And I think places like Florida and Texas and the Gulf Coast area are places where you might see more of a real correction. I don't think that you're going to see as much of a downside, but maybe just a pause in price increases elsewhere in sort of the Northeast and Midwest.
To your point, Last Bear. So back in February, I wrote a piece, actually as part of my interview with Maggie Lake, talking about the deflationary versus the inflationary components of the Trump 2.0 playbook. And the deflationary aspects are, the deregulation, cost cutting, agency purges, getting oil down. And then inflationary, at least by consensus, were the deportations, tariffs, tax cuts, deglobalization. But as you point out, and as I pointed out in my piece, the deportations and the tariffs are both a double-edged sword. Tariffs, we already talked about the demand destruction components, but the deportations, as you point out, right, while it reduces the labor pool, it also reduces housing demand. So I wrote in that piece that, I think that on balance, I see the Trump 2.0 playbook as net deflationary. And in my oil piece about what kind of conditions would it take to have sustainably lower rates and a weaker dollar? I think that low oil in and of itself is a necessary but insufficient condition for that to be accomplished. But I do think that perhaps when you take the rest of the Trump 2.0 playbook in its entirety, they might produce those sufficient conditions. So the jury is out on that, obviously.
So I just point out that the price action now is, equities are selling off and it looks like bonds are rallying. So, I mean, if it's just the Fed, that would suggest some kind of growth concern. But I think we also have headlines coming out about Trump's discussion on China, saying that he wouldn't lower tariffs ahead of time. So that could be part of it as well. But I've also learned that on these days you have all sorts of options activity. So I don't know if Jim has any insight, if there's any positioning around options around now that could be skewing interpretations of the Fed.
Yeah. So the big takeaway here is on the options space is we had all this weekend uncertainty that was just created yesterday, right? I think that's a big deal here. Everybody's wondering, what is this big deal that's coming this weekend? What is the big positive news, the deal? And the reality is they aren't explaining anything. They're just leaving a kind of big uncertain question mark there. You got to wonder if it's the administration trying to get in front of the fact that the Fed's not cutting and that the market's likely to not take this very well. But there is this vol pump that happened for Monday, really coming in last night into today. And that's creating kind of a short gamma situation in the short term. Interestingly, the 12th vol was like the one vol that was kind of available across the board in options land. It was a gamma that was really hedging out the May OPEX. Behind that, you have the 13th, which is obviously CPI. And as I mentioned, one of the top things we're talking about on here in the big debate, there's a lot of, you guys, myself, all disagree. There's a lot of uncertainty about what the inflation numbers are going to look like. And so the 12th, the 13th, and you have May OPEX, and then you kind of have a bunch of vol risk behind that in a June quarterly OPEX, and quarterly OPEXs are always some of the most dangerous. So the big story here in terms of positioning and flows is that the supply of vol and all of the things that led to kind of the Vonacharm support into this window and the bounce back to the 1.5 standard deviation of the 20-day, the 50-day moving average, all the things that we said would happen here off the bottom is now going away. And so the big story is vol is no longer offered, gamma is in short supply, and the market is slowly becoming unpinned here.
So with about 15 minutes until Jerome takes the podium, I want to touch a little bit on that topic of treasuries, the bond markets. In April, the 10-year treasury yield, which, as we know, is a hot topic when we're discussing recessionary pressures, inflation, the economy as a whole, the 10-year jumped, I think, 3.99% to 4.5% just in April alone. And so my question to this is, especially looking at their reaction today, is this reactionary to inflation nerves, or are we seeing some kind of deeper shift in the global trust in the U.S. fiscal policy? Let's start with Bob here, and then I'd like to get Michael and Lasbear in on this one as well.
Well, I'll take a position that's contrary to many of the most extreme doomers, that the bond market is likely to trade consistent with sort of its normal, particularly growth-oriented behavior, meaning that when growth dynamics are going to be weaker, that they'll probably rally, in particular relative to stocks, and similarly the opposite direction. And so and circumstances like today, even the rally period in stocks looked more like stocks rallying relative to bonds, and then similarly we've had a bit of a rollover there. The bid for bonds, of course there's the corner case that a bunch of reserve managers decide to sell out their reserve holdings in order to punish the US. But the odds that that's going to happen, or even if it does, the odds that you're not going to get a bid from domestic demand in one form or another, particularly if the yield curve steepens, is pretty low. And so I think in some ways, and then ultimately, if the yield curve steepened or rates went to a level that was unacceptable from the Fed's perspective, they could, of course, start buying the bonds and bringing yields down. And so I think all of these things are effectively emphasizing that there's much more of a put in bonds than there is a put in stocks. Because ultimately, bonds in many ways sows, bond yields, any bond yield rise, particularly relative to conditions, sows the seeds of an inevitable rally as economic conditions will and asset prices deteriorate in a way that for stocks is totally different. Stock falls are self-reinforcing to the downside. And so I just keep that in mind. My guess is, bonds are going to continue to be a pretty good diversifier, not a pretty bad diversifier on a forward-looking basis.
So as
I actually disagree.
Oh yeah, go ahead, Jim.
I want to highlight one important thing on the bond side. Everybody seems to think the 40 will hedge the 60 again. Guess what? It's not going to work again. This has been something we've talked about on here for 4 to 5 years. Why? Because inflation is not going away. I just want to be clear. Inflation is not going away, and it's actually the issues and the structural things that have caused it now for 4 years are only getting accelerated. We are spending more. I want to highlight, we are spending more than the last 8 years and 12 years and everything else we talked about, right? We're spending more and we're cutting supply to companies. We have a bi-pronged inflationary pressure that all of a sudden nobody seems to appreciate. Everybody's just focused on recession. Everybody's focusing on the wrong side. By the way, I'm not saying we're not going into recession. I am not saying that we won't get some incremental slowdown. I'm saying the inflation part of the stagflation is much more important right now. And that's what the Fed is talking about. That's why the Fed's not moving. Again, we can debate whether or not that taking money from the top 10% and giving it to the bottom 40% is GDP, hurts GDP or not. Yes, it will probably slow things down because we're taking generally more away, but the amount of actual spending likely won't decrease that much. Corporate profits may decrease. You may get an earnings recession, but at the end of the day, the issue is not revenue decreases for companies. The issue is profit decreases, and the difference there is that remains inflationary. And so I don't agree at all that the long end of the curve is somehow going to save you from an equity deterioration. Now, that doesn't mean the long end of the curve is going, the yields are going higher, but it does mean, to be clear, that it's not going to give you the protection you need in an equity side.
Last Bear, I saw you had a little reaction there as well. Did you have a comments before I pass to Michael?
No, you could pass. I was just encouraging the point about the points that Jem was making.
Fair enough. Michael, go ahead.
I think the crux of our disagreement here is really what happens to inflation longer term. And as a result, I mean, I outlined my reasons for why I think that, I actually think that inflation will get tamed by a slowdown. So if anything, gun to my head, I actually expect a bigger likelihood of a flattener than a steepener. And just to say something about the hyperventilation about the sell everything US related hyperbole that we've been hearing, I do think that a lot of that has to do with animus towards Trump. But that said, memories are short in the market and rate differentials will rule the day. So when you look at whether it's the 2-year or the 10-year, rate diffs right now are, I think, going to lend support to both the US dollar and to longer duration bond markets. And just one last comment, just to put things into perspective, the 10-year today is actually 2 basis points inside of where it was back on November 4th. So for all the, sell everything US, sell the dollar, sell US bonds, sell US equities, I think a lot of that is just hyperbolic.
So to kind of tie on to that, Bob, I see your hand and I would love your comments in addition to your answer to this. Do we think we're heading into a higher rate world for the long haul, or will we see some normalization amidst the bond markets once inflation and the geopolitics situation kind of cool off?
Yeah, I mean, I think that the main question is, in the event that we see a weakening of economic conditions, what does the Fed prioritize? And in that case, like I think the sort of traditional emerging market balance of payments framework is a pretty bad framework, one that many people are sort of looking to in terms of like the sell everything in the U.S. context. And the reason why that is because while the U.S. is significantly reliant on foreign capital, and particularly reliant on unhedged equity foreign capital in the last 10 years, the choices, given the fact that debts are in dollars, and that the U.S. economy is a large, diversified, mostly domestically oriented economy, the choice for the Fed is very clear, which is you respond to domestic economic conditions in your policy pursuits. And what that means is if you have weakening economic conditions, you cut interest rates. And there's nothing about and the trade-off there is that you'll have a weaker dollar. So if you think that there's a sell everything US trade that's likely to occur, you're in much better shape going long bonds relative to stocks and short the dollar than going short bonds relative to cash. It's a much higher probability trade, focusing on U.S. stocks on a relative basis, short U.S. stocks on a relative basis to the rest of the world, than focusing on bonds. Because ultimately, if it plays out, that way, that there is capital being pulled out of the U.S., the bond market is not going to feel the effect. It is not going to feel the pain over the long term because the Fed will deliver the policy appropriate for domestic conditions.
Thank you, Bob. So we've got about 6 minutes less, but I am wondering, on the topic of the US dollar, on the topic of US debt, Japan specifically has been buying more US debt, but on the other hand, China's been somewhat quietly cutting back. And I'm wondering, does that say anything about how the world sees our economic stability right now? Let's go Joseph, then last Bear.
So I think Bob makes a really good point in that, in this framework, in the future if we were to have economic trouble, the Fed would cut rates, and what you would sacrifice is the currency. Now that actually has a big impact on whether or not foreigners are interested in holding U.S. assets. So let's say going forward, the Fed will act in a way that, buffers the domestic economy at the expense of the currency. Then if you're a foreign investor, you're going to get currency losses on those U.S. assets. And so I think that impacts demand for U.S. assets and could, I think, on the surface look like a sell America trade. So maybe part of the reason that foreigners seem to be less interested in dollar assets is that they're afraid that going forward we will have a dollar weakness or depreciation, and that would impact their returns in local currency.
I'll add a couple comments about this because this is a topic near and dear to my heart. So 2 years ago, I co-authored a paper that we presented at West Point that talked about U.S. dollar primacy in an era of economic warfare, really examining the pillars of national power that ultimately determine both dollar strength and dollar adoption. Right, those are two often conflated issues. And what makes the dollar the global reserve is a whole host of pillars of national power. It's not just about debt to GDP, which is a singular stock to flow metric. You have to also consider the quality of the US asset side of the national balance sheet that no one ever talks about. And then, of course, when you talk about the history of the US dollar and the evolution of the Eurodollar market, it came about because at that time, the US was the upstart superpower relative to Great Britain. Now you could argue that yes, the current liberal world order is fragmenting into a more multipolar state. But the difference this time is that there is no upstart that surpasses the US in all elements of national power. China is attempting to, at least on the military side, but they're nowhere on the cultural side, and even on the economic side, they're still not there. And so I think ultimately also a key prerequisite is for the dollar ecosystem is to have a deep and liquid and supply elastic sovereign bond market. The EU doesn't even have one. China doesn't have one. China has, and furthermore, China has a closed capital account. So there is no fiat alternative to a reserve asset relative to the U.S. Treasury bond. Now, what about gold? Well, if you look at China, right, a lot of this hyperbolic move in gold has been because China is in this unenviable state of not wanting to increase its reserves of U.S. Treasuries, but they have very few places to go, and they're basically plowing money into a supply inelastic asset. Well, that's great if on the way up, but I always like to say the sort of supply inelasticity cuts both ways. What happens when the PBOC needs to actually sell those reserve assets? Well, if they're primarily in gold, then you can have a very, very severe decline. Like you could have like a multi-$100 day decline in gold if that shifts. So that's the problem. So I don't see the US dollar or the US Treasury market going anywhere relative to its share of global adoption, really.
Thank you, Michael. Last Bear, Joseph, Bob, and Jem. Last Bear, do you have one last comment before we kick the listeners over to JPow?
I'll just say super quickly, just on U.S. versus rest of the world, think about relative value as well. So U.S., when we talk about markets, people thought that China was uninvestable a year ago. Now it's significantly outperformed S&P. Earnings yield in Europe is still significantly higher than what you get in the U.S. So relative value matters on that front. But I'll leave it at that. And I know you're going into exits, so I would just say you can follow me here on Twitter and follow my Substack if you're interested. Thanks.
And thank you. Everybody, if you're not following these folks, get on that. I learned more from the panelists we have on these FOMC panels than I learned in the last 10, 15 years of life. They're just so crucial to staying on top of things that are happening in macroeconomics. I can't thank them enough. We've got Jerome Powell in about 30 seconds, so give me just a minute to get that set up, and we'll be piping that audio directly into the space here. It's also live on our YouTube channel.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. You know, I think, if you look at where we are today, we have an economy that, if you look through, you know, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And, you know, we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by about where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
You know, as I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And you know, when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and you know, as that develops, and I can't really give you a time frame on that.
Janelle.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, I mean, so let's look back and see where we are. So go through 2024 up to the day. We've had unemployment in the low fours for more than a year. We've had inflation coming down now in the mid to low twos. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They really have. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools. which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential. And we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not in your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way, but that's not at all what we meant. So that's just not a correct reading of our, but I can see how, maybe people found that confusing, and we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses, big and small, are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about the, a shock from the tariffs, but they really haven't, that shock hasn't hit yet. Okay, so, we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen. 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
You know, we don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path. And it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decision. So the volume of the imports, imported goods has increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney.
Courtney Brown from Axios. I guess, we talked about some of the
indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Chair Powell, Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
All right, everybody, that concludes our FOMC panel here on Unusual Whales. Be on the lookout later this afternoon. If you came in late and feel like you missed stuff, this will be released as an Apple and Spotify podcast, as well as on YouTube. Until then, thanks for coming, everybody, and I hope the rest of your day is less of a roller coaster than the markets are right now. Take care, everybody.